Hello, in this video, I'm going to talk about consistency and what consistency actually means for webcam models, and most importantly, how to achieve it. So, consistency is a topic that is talked about a lot in the webcam modeling community and in guides, in other training, in advice given from other models to other models. It's talked about all the time. Everyone says consistency. Just be consistent and you'll get consistent results. But from what I've seen, consistency is widely misunderstood in the industry as a whole. So in this video, my goal is to properly define consistency, what consistency looks like, how to achieve consistency, and just give you a full understanding of what consistency actually is. So my name's Ben and I'm from Xcite MGMT. So first of all, let's start off with the definition of consistency or consistent. So, consistent, acting or done in the same way over time, especially so as to be fair or accurate. So, the key word here is time. So, most models massively misunderstand the time aspect of this definition. So, we're going to get into that fully later on, but that's the key. The key problem is the misunderstanding of the time aspect. So there's two layers to consistency, and we're going to cover both of them today. So consistency of behavior and consistency of outcomes, which are not to be conflated. So they are conflated a lot, and they are just grouped into this one idea of consistency. But in this video, we're going to break down the two types of consistency, how they are connected, and how they affect each other. So why is it actually important to understand consistency? Why should you watch this video and really take the time to understand what consistency actually is? So it'll give you a massive advantage over the competition. So most people do not, especially in the webcam industry, do not understand what we're going to talk about in this video today. And if you do, it's going to give you a massive advantage over the rest of the competition. So it allows you to continue level-headedly while others emotionally make decisions, overreact, and give up on winning strategies and quit. So it allows you to stay in the game, iterate and improve over time to develop into a high-performing webcam model. So basically, it allows you to regulate yourself with data rather than emotions, simply because you understand the data that is actually involved. So here are some common misconceptions about consistency. So consistency means every day should produce similar results. If I'm consistent, volatility should disappear, and we'll get into exactly what volatility is later on. A bad day means I'm doing something wrong, and then a good day means I'm doing something really good. So all of these are false. These are common ones, and they are said a lot, but they are all false, and we're going to explain exactly why in this video. So at the start, I said there was two types of consistency: consistency of behavior and consistency of outcomes. So let's start with consistency of behavior. So this is the easiest part of consistency to understand, and it's pretty well understood, and it's pretty simple. Consistency of behavior is basically consistent inputs. So these are things like your schedule, the length of your stream, and then just sticking to the system that you have. So if you do have a well-defined system, then the consistency of behavior is just the behavior of sticking to it. You just have to stick to that system every day, and that is consistency. That's the consistency of your inputs. So these are things that you directly control. So there's a video on the channel about thinking in systems applied to webcam modeling, where we look at the inputs, the processes, the outputs of webcam modeling. And this is the input stage. So this is just stuff that you directly control and have 100% influence over. So this is the first step, but most models don't even have this part correct yet. So this is the first step to consistency as a whole. If you can't get your inputs consistent, then essentially you can't expect anything else downstream from that to be consistent. It's the first step. You just have to be consistent with your inputs every day. So they don't understand that consistent inputs equals consistent outputs. Most models don't really, they might, most models don't understand it. If they do understand it, they don't act on that information and they do not remain consistent. So even if you are a model that understands this and is consistently executing every day, then just doing this is not enough, because not only do you have to be able to do this, but you have to be able to continue providing the consistent inputs over a long enough period of time in order to see any meaningful changes or results. So if you have misdefined what the consistent outputs look like, which I think a lot of models have from what I've seen, then you're more likely to give up or change the inputs before they've had a chance to actually reflect. So, aka make more money consistently. So if you have this idea in your head of what consistent outputs look like, and you're giving the consistent inputs, you're turning up every day, you're taking the right actions, but the outputs are not what you have defined consistent to look like in your head, then you're going to give up. You're going to change the inputs, but they, it's not the wrong inputs. It's just that you've defined the output incorrectly. So you're referencing your outputs against the desired outputs, but it's not realistic, which we're going to get into now. So consistency of outcomes. This is the most understood part of consistency. So consistency of outcomes are the outputs of the system. So as we've discussed, models think consistent inputs equal consistent outputs, and they're right. But as I mentioned earlier in the video, the time or the time frame that they define and measure consistency on is wrong. So they massively underestimate the time or the time frame aspect. Models think that daily inputs equals consistent daily outputs. So basically, 4 hours in equals roughly $400 out every day. So if every day they turn up and they put 4 hours in, then they're going to get $400 out. If they turn up and they put 2 hours in, they're going to get roughly $200 out every day. So this leads to the misconceptions that we saw earlier on. If the earnings drop to, say, $200 for the same 4 hours of work, then they panic and they start changing all the inputs. If they make $1,000 that day, they celebrate and they think they're going to make $1,000 every day. Spend it all and then just take a couple of days off, because they think from now on they're going to be making $1,000 a day, and that is just the level they're at now as a model. So you can see it's very emotional swings from lows to highs. So most models judge their consistency of these daily outcomes, but these daily earnings are simply noise. So they're using these daily earnings to evaluate their consistency, but it's ultimately the wrong time frame to evaluate consistency on. So they're putting weight to noise, essentially. They're seeing the daily earnings, they're seeing the fluctuations, and they're attaching a lot of weight to that, to those fluctuations, and then they react emotionally. In this example, $200 when they're used to $400, they panic and they change things. If they make $1,000 a day, they celebrate, and then they take their foot off the accelerator because they've made $1,000 that day. So they must be doing something amazing, something must have changed. So they react emotionally. Consistency of outcomes again. So what do actual consistent outcomes look like? So we have an ideal line, and this is an ideal line that goes from bottom left to top right at 45 degrees. So essentially, this is daily earnings mapped to days over a 90-day time period. And you can see the earnings start at $400 on the bottom left, and it goes up to $500 in the top right over a 90-day time period. So these are their earnings per day. So this is the ideal line. This is what every model would want to see in an ideal world. Every day that they're streaming, their earnings are going up linearly. Every day is getting better. And they start off making $400 a day. By the end of a 90-day period, they're now at $500 a day. And hopefully this will continue indefinitely. So this is the ideal line. And in an ideal world, this is how every webcam model's results would look like. So the reality of this is earnings and progress never look like this. It's impossible. So humans think linearly. We expect linear outcomes for linear inputs and improvements over time. So humans are not very good at visualizing and understanding non-linear progress in their minds. So we think if I show up consistently, results should go up consistently. But this is not the case. So why? So your daily earnings will always have variance regardless of how consistent your inputs are. So, but this does not mean consistent inputs are wrong. So day to day, the noise that you're seeing from the daily earnings, this is always going to change. It's always going to go up and down, but this does not mean what you're doing is wrong. This does not mean you need to change anything. It does not mean the inputs are wrong. So the webcam industry has so many external factors that are beyond your control. And this is essentially the environment that you operate within. So going back to the systems thinking video, you have your system, which is you, what you can control, and then that system operates within an environment. In this case, this is the webcam site's ecosystem. There are so many variables and factors within that ecosystem that are completely out of your control, and you'll never be able to directly affect them. So just as you cannot control the weather, you cannot control the external factors of the webcam site ecosystem. But those factors do have a big effect on your daily earnings. So you can only control what you can control. And if your inputs are directly under your control and you're providing the same consistent inputs daily, because of the variance of the cam industry and the webcam ecosystem, all of these different variables and factors are affecting your daily earnings. Even if you provide consistent inputs, the outputs are always going to fluctuate. They're never going to be consistent, or well, what we define as consistent. So what do real consistent daily earnings look like over time? So we can see here the same 90-day time period, and we can actually see the exact same end result of this 90-day time period. We are starting at $400 and going up to $500 a day by the end of the 90-day period. But you can see the graph looks drastically different. So we've got the same start point and the same end point, but different levels of volatility between the two graphs that we've just looked at. So with this graph, it's exactly the same. We're making the same progress over the same period of time, but as I said, everything just looks completely different. So you can see the day-to-day fluctuations. Some days we're dropping massively below the moving average. Other days we're going massively above the average. But over time, we are averaging at that pink line. So you can see I've written panic at this big dip here, and that's maybe day 7 or 8 on this graph here. And you can see if this is a model streaming, she's making $300, then $500, then this dropped down to like just above $200, and then we have a big drop down a couple of days later to just above $100. So seeing the graph now, you can quite easily understand what's going on, and you can see that the right thing to do is just to keep going. But if you're the model in that position at that time, and you're used to $400, then $500, and then you drop a bit, and then you get a $600 day, and then you get a $100 day, maybe that lasts for 2 days in a row. You might be thinking to yourself, something's gone seriously wrong here. I'm doing something wrong. I need to change my system. I need to change my inputs. I need to change the way I'm behaving on camera. Something's clearly not working. But when you zoom out and you see the full picture, you see that that is just the normal variance. So what this essentially is regression to the mean. So over time, the highs will cancel out the lows. Sorry, the lows will cancel out the highs, and over weeks and months, the randomness will cancel out, and your true average will appear. So that is the pink line that we can see on the graph here. So you can see these wild swings to the upside, wild swings to the downside. But over time, when you map out the average, the randomness disappears, and we see the consistent uptrend. And in fact, we see the exact same consistent uptrend as we see here 400 to 500 over a 90-day period. But obviously, it looks a lot different and it feels a lot different for the model involved. So, but this is reality, and this is what reality looks like. We'll never have a reality that looks like this. So we have to understand this so we can operate best within it, essentially. An important note, though, is consistency does not equal good. So another thing that gets conflated in CAM model industry, all of the discussion groups, like the Reddit, subreddits, etc., is consistency is conflated with good. So in the examples I've just shown, average earnings are trending upwards, but that won't always be the case. And just because you are consistent does not mean you're consistently good. It's just one half of the equation. So if you're providing consistent inputs and over time, over weeks and months, your earnings are consistent, that does not mean you are consistently improving. It just means you're consistent. Some models stay consistently flat, so they just hover around a certain earning line, maybe $400 or $500 a day on average, and then over weeks and months, that's whatever that is, $1,000, $2,000, $5,000 a week. Many models consistently trend downwards, so you can this could be reversed. You could be consistently going downwards, but high performers consistently trend upwards over time, not day to day. As we've discussed, the day-to-day earnings are just noise, but over time, the weeks, the months, the averages, they trend upwards for high performers, and that is the ultimate aim. So let's look at volatility. Volatility is a measure of how much your earnings swing above, below your average. So you can see we've got the pink average line here, and then you've got these swings to the upside, swings to the downside. Volatility is basically a measure of how big those swings are. So if we look at this example, there are no swings, so we've got very low volatility. If we look at this example, we have more volatility. We don't know if this is high volatility or low volatility because we don't have anything to reference it to, but there's more volatility here, and these swings to the upside and downside is what volatility is measuring. So in an ideal world, we would have no volatility. And like I said, the earnings would look like the ideal 45-degree line. But we will always have volatility, but less volatility is preferred as it gives us less uncertainty around day-to-day performance and more overall predictability. So high volatility is not necessarily bad, and you can be a very high-performing webcam model with very high volatility. But in order to maintain that over time, it does require more emotional resilience. You have to be able to withstand these high peaks and high troughs and recognize them for what they are and not become emotionally attached to them, essentially. You have to just emotionally regulate yourself. So you can calculate your volatility so that you can quantify these random swings. Once you've quantified them, it allows you to understand your expected volatility so that you don't panic when you see these swings and you see when you see the swings in either direction, to the upside or to the downside. And then you have a metric to work on improving over time. So say you are a model who is earning a decent amount of money consistently, but you really do not like the swings that you experience and it doesn't you find it hard to deal with emotionally. Then if you understand your current volatility and you can quantify that, then over time you can work to bring that number down, reduce the volatility, reduce those wild swings, and earn the same amount of money, but with less variance. So this is how we can regulate ourselves with data rather than using emotion. So if we're going to regulate ourselves with data rather than emotion, we have to understand the data and we have to have the data. So to calculate a simple volatility measure for your earnings, just got 5 steps here. So you can take the last 30 days of earnings, the more, the better. If you want to do this on a month by month period, you can work out your previous 3 months volatility, the individual volatility metric for each of those months, compare it to your current month, and then you can view volatility as a trend over time and see if you're increasing the volatility, decreasing the volatility. So take the last 30 days if you want to give yourself a bigger picture and understanding of it, then you can just plug in more numbers, but calculate the 30-day average, so the mean, add all 30 days and divide by 30 to do that. For each day, calculate the deviation. So just take the individual daily earning, take it away from the average, and then this shows how far above or below the normal each day was. That way, then you just do that for every day, and then you calculate the average deviation. So you take the deviation from each individual day over the 30-day period, and then you average that number. So this gives you a simple volatility number, and then you can use this to set your normal expectations. So once you have that number, you understand you have something to reference your current and your past volatility to. So like I said, you can work on improving that there over time. So taking the example of the data that I showed earlier, I won't go through the entire calculation, but essentially that data shows us we have an average volatility of $85, which means on an average day, we might swing $85 up or $85 down. That is 20%. So the absolute volatility is that amount in dollar terms. So $85 is the average swing to the upside, average swing to the downside over this period. And then the relative volatility is that given in a percentage figure, so 20%. So on an average day, we might go 20% to the upside or 20% to the downside. But once we know that, we understand that that is completely normal. So I will say 20%, it looks like a lot on this graph, but in reality, I've seen high-performing webcam models with volatility of 50%, even higher. So 20%, it looks like a lot, but in reality, yours might be way higher than this, or it could be lower. So this is then comparable to time period to time period. So like I said, you can compare it to previous time periods and compare that to now. Okay, so emotional regulation. This is really the main benefit of understanding all of this data, understanding the concept of consistency. So once you have the data, it allows you to regulate yourself using it rather than just relying on emotions and your day-to-day feelings. So you don't act based off how you feel day to day because you understand the system, you understand what's normal, so you continue regardless of the day-to-day fluctuations. So most models panic during these drawdown periods. Basically, that just means the periods where maybe for 2, 3, 4, 5 days in a row, you are under your average, you're underperforming compared to your average number. So if you're used to $500 days, maybe you have 4 days, 5 days in a row where you make $200. And then from that, if you're regulating yourself with emotions, you're going to jump to the conclusion that something is seriously wrong. And then you're going to break your system if you have one at all, or quit. So having this data and understanding it allows you to continue regardless. When you're in that drawdown period, you understand this is normal. This isn't a trend. This is just noise of the day-to-day fluctuations. This doesn't necessarily mean what I'm doing is wrong. It doesn't mean my system's broken, and you can continue to push through it. So most models don't even have a system, but if they do, when they experience these drawdown periods, they panic or they quit, and they don't let the trends play out. So they misinterpret normal volatility as something is wrong. So you'll often see posts in support groups and forums where a model has had a decrease in earnings over the past week, maybe 2 weeks, and they think the entire camming industry is coming to an end. They think the economy is collapsing, or they think that they're no longer attractive, for example. But when you understand the data, you understand this is normal volatility, and you need to let the trend play out to analyze the real data behind the trend. So Why is consistency a superpower? Because it is when you understand it and you implement it. Consistency works because of the amount of exposure to the high variance environment. So what does that mean? So the webcam site is the high variance environment. And if you're consistent, you're essentially just increasing the amount of overall exposure to that environment. Why is that good? Well, each time you stream, it's another chance for a high earning day to appear. So you never know when it's going to be a good day. You can't time the good days. You never know when a high spender will enter your room. And maybe on one particular day, you're going to earn 3 to 4 times your average. If you didn't turn up that day because you didn't feel like it, then maybe you missed that day. And maybe that day was this peak in the middle here on this graph. And that is what brought your average up for that period. But if you missed that day, then you wouldn't have been exposed to it, you wouldn't have been there, and you wouldn't have benefited from it. So missing streams because of emotions, basically regulating yourself emotionally, reduces your exposure to these high earning days. It doesn't allow for variance and regression to the mean to play out, and it basically just makes earnings feel random and keeps your long-term averages unstable. You cannot time the good days. You just have to be there every day to experience them. And the only winning strategy, really, is to show up consistently, allow the randomness to occur, catch the wins, experience the slow days, and work to make sure that over a long enough period of time, you are trending upwards. That is the only winning strategy, really. You cannot time the good days. You cannot try to predict when the traffic is going to be at a higher volume on a particular site, on a particular day, at a particular time, because there is so much variance. There's so many external factors. Maybe you do think it's going to be a slow day, and maybe you think the traffic is just not going to be there. But if your system says you should show up, then you should show up, because maybe that day is the day you find a whale during a quiet period. He comes in and he spends 4 times your daily average in the space of an hour. You never know. There's so many external factors, so many variables. So you just have to show up daily for regression to the mean to take effect and for your month-to-month earnings to stabilize. So you can then see the real trend and constantly work to make sure you are trending upwards. But without consistency, you just won't trend at all. It'll be noise, it'll be fluctuations long term, not just day to day. You won't see the real trend. And if you don't know the real trend, you cannot work to improve it. You have to stabilize your earnings to understand your true earning ability and where you really are, and then you can work to improve it. Then, when you improve it and you combine that with consistency, you get both sides of the equation that I earlier mentioned, and that is what equals a high-performing, high-earning webcam model over time. So, to link this concept to another domain, you can look at trading and casinos. So, webcam modeling and the idea of variance, volatility, all of this is basically very similar to how traders approach their profession and how casinos operate. So professional traders, they don't pick and choose their trades, they just follow their system. They have a system and they execute it regardless. They let probabilities play out and they ignore randomness. So they don't measure outcomes over hundreds of trades. Sorry, they measure outcomes over hundreds of trades, not one or two. So they don't lose once, twice, maybe even 3 or 4 times in a row and decide that their system is wrong and that they need to change everything. They understand the variance, they have a system, they execute it regardless of emotion, they follow the plan, and they allow the randomness to occur. They know that slow days to them are losses. They know that these days are going to occur, and that's part of the game. They have to just accept it. They have to just be there, turn up, be in the market, execute their system. Some will win, some trades will win, some trades will lose. But if they don't, if they start trying to pick and choose the ones that they think they're gonna win and they're gonna lose, and they don't just follow their system, then they're not they're not going to allow for all of the things that we've talked about today. They're not going to allow for regression to the mean. and they're not going to allow for the variance that takes place. They're just, if they put too much weight and emotional attachment to volatility, to the swings to the upside, the swings to the downside, to the wins, to their losses, then over time it's going to be a mess. It's going to be chaos. They're going to have no edge, and they're going to lose money essentially. And it's the same with webcam modeling. You just have to have your system. You have to show up. You have to execute your system every day. You have to understand why the outcomes are still going to be inconsistent day to day. Why you're going to have that variance. Why you're going to have those swings. Don't put too much emotional attachment to it, and execute regardless, so you can get a picture of your long-term average. Once you have a picture of your long-term average and it's stabilized, then you can see, am I trending up? Am I trending down? Am I staying flat? Then you can make changes to your systems, but you can do that with data rather than emotion, regulating yourself with data, not emotions. So it's exactly the same with casinos. They don't try to control every game, each individual game. They understand variance, and they know over a long enough time horizon, their edge will put them on top. So they just show up daily and let probabilities work in their favor. They know that they have a slight edge. Uh, they know they have an edge over the player. It's only a small edge. So they know if they show up every day over time, then that edge is going to benefit them, and they're the ones who are going to come out on top. So you have to apply these same mental models to your webcam model. So hopefully this video has been helpful. Hopefully now you have a clear picture of what consistency actually is and how to achieve it. Hopefully you can go away and calculate your own volatility numbers and give yourself a reference point to work with and to improve on. If you have any questions on any of the things I've discussed, or don't quite understand anything, then you can leave a comment and I will get back to you. If you like these type of videos, breaking down the webcam modeling industry and topics like this, then subscribe to the channel, as I'll be posting more frequently videos like this. There's also other videos on the channel going more in depth onto the things like systems thinking, which I referenced in this video. So if you want to watch that, it's on the channel. Go and have a look. And if you are a webcam modeling who wants help implementing systems, strategies, tactics, and really becoming a structured professional webcam model, doing things the right way, there's a link in the description to our accelerator program, which will teach you all the systems and everything that you need to know to be consistently profitable and trend upwards over time.